Imagine this. You're ready to invest, but you're stuck between two of the most powerful ETFs in the world, VTI and VOO. One covers the entire U.S. stock market, while the other focuses on the top 500 companies driving the economy. But which one is truly the best for your portfolio? In this video, we're putting VTI and VOO head-to-head to help you decide which ETF deserves a place in your investment strategy. Stay tuned, because this choice could make all the difference in your financial future. ETFs have become one of the most popular ways to invest, and two of the biggest names in the game are VTI and VOO. But here's the thing, they may both be Vanguard giants, but they aren't the same. VTI gives you exposure to the entire U.S. stock market, from large caps to small caps, while VOO narrows its focus to just the top 500 U.S. companies in the S&P 500. The question is, which approach is right for you? Do you want maximum diversification with VTI, or are you looking for the proven stability of VOO? In this video, we'll break down their performance, key differences, and which one might give you the best chance to grow your wealth over the long term. So, whether you're just starting out or fine-tuning your portfolio, this comparison will give you the answers you need. If you want more tips on building wealth, hit the subscribe button. Your support helps us create more valuable content for you. Let's kick things off with VTI, the Vanguard Total Stock Market ETF, which is one of the largest and most comprehensive ETFs out there. As of now, VTI holds a staggering $430 billion and $97 million in net assets, making it a powerhouse in the investment world. At a market price of $277 per share, you're getting access to over 4,000 U.S. companies in one single fund. Talk about diversification. Now, here's the beauty of VTI. It covers every corner of the U.S. stock market, from large-cap giants like Microsoft and Apple to small-cap stocks that could potentially be the next big thing. This means you're not just investing in today's market leaders, but also in the future of the U.S. economy. And with an incredibly low expense ratio of just 0.03%, it's one of the most cost-effective ways to capture the growth of the entire U.S. market. But let's talk about performance. VTI has been on a roll, delivering a year-to-date return of 16.88% and a one-year return of 26.04%. Over the past 5 years, it's averaged an impressive 13.4% annual return, and over the last decade, VTI has provided an average return of 12.31%. So you're getting consistent long-term growth. And that's not all. VTI also pays a quarterly dividend, with a dividend yield of 1.32% and an annual payout of $3.66 per share in the past year. Now, let's dive into VTI's top 10 holdings, which represent around 29% of the fund's assets. You've got heavyweights like Microsoft, 5.94%, Apple, 5.13%, and Nvidia, 4.21%, along with names like Amazon, 3.36%, and Alphabet, in both Class A and C shares. These companies aren't just leaders in their sectors. They're shaping the future of industries like tech, e-commerce, and artificial intelligence. So, if you're looking for an ETF that gives you exposure to the entire U.S. stock market with a mix of large, mid, and small caps, all at a low cost, VTI might be the perfect fit for your portfolio. It's an all-in-one solution for long-term growth, making it ideal for investors who want broad exposure and steady returns over time. Let's imagine you're investing $100,000 today in VTI. With a 5-year average annual return of 13.4%, your $100,000 investment would grow to $187,122 after 5 years, and you earn approximately $6,996 in dividends. If you stayed invested for 10 years, your portfolio would expand to $319,620, and your total dividends would be around $25,785. Looking at a longer horizon, after 20 years, VTI could grow your investment to $1,020,386, and the dividends would accumulate to about $82,893. And after 30 years, that initial $100,000 could potentially reach a massive $3,258,476. And your total dividend earnings would be a substantial $222,580. That's the power of long-term investing and compounding growth. Now let's dive into VOO, the Vanguard S&P 500 ETF, which is all about investing in the largest and most stable companies in the U.S. market. With $508.72 billion in net assets as of September 2024, VOO is one of the most trusted ETFs out there. At a market price of $516 per share, you're essentially buying a piece of the top 500 largest U.S. companies, giving you exposure to industry leaders across the board. The beauty of VOO lies in its focus on large-cap stocks, the well-established dominant companies that have consistently driven the U.S. economy forward. You're looking at heavyweights like Apple, 6.90%, Microsoft, 6.70%, and Nvidia, 6.20%, alongside other giants like Amazon, Meta, and Alphabet. These top 10 holdings alone make up around 34% of the entire fund, meaning you're investing in the leaders of tech, finance, healthcare, and beyond. With an expense ratio of just 0.03%, VOO is not only incredibly affordable, but it also ensures that most of your investment is going directly into the market, not into fees. And it's not just about growth. VOO also pays a quarterly dividend, with a dividend yield of 1.28% and an annual payout of $6.62 per share over the past year, making it a solid choice for both growth and income investors. Now let's talk performance. VOO has delivered a year-to-date return of 17.43% and a one-year return of 25.47% as of September 2024. Over the past 5 years, VOO has averaged a strong 15.87% annual return, and if you zoom out further, the 10-year average annual return stands at 12.94%, which speaks to its long-term stability and growth potential. So, if you're an investor looking for reliable long-term growth from the top U.S. companies, VOO is a great choice. Its focus on the S&P 500 means you're investing in the backbone of the U.S. economy, with a proven track record of solid returns. Whether you're seeking a core holding for your portfolio or a low-cost way to tap into the market's biggest players, VOO offers both security and growth potential. Let's imagine you're investing $100,000 today in VOO. With its slightly stronger 5-year average annual return of 15.87%, your $100,000 investment could grow to $208,278 after 5 years, and you earn approximately $6,848 in dividends. Over 10 years, that same investment would expand to $336,477, and your total dividends would be around $25,039. If you held on to VOO for 20 years, your investment would be worth $1,147,719, and the dividends would accumulate to about $93,239. And after 30 years, you'd be sitting on $3,783,301, and your total dividend earnings would be a substantial $260,922. Now that we've explored VTI and VOO, let's put them head-to-head. Both are top-notch Vanguard ETFs, but they take slightly different approaches. VTI offers broader market coverage with exposure to around 4,000 stocks, spanning large, mid, and small caps, whereas VOO focuses strictly on the S&P 500, which includes the top 500 largest companies in the U.S. When it comes to fees, both ETFs are equally competitive with an ultra-low expense ratio of 0.03%. ensuring you're keeping most of your returns. In terms of dividends, VTI has a slight edge with a 1.32% dividend yield compared to VOO's 1.28%, though both pay dividends quarterly, providing a steady stream of income. Performance-wise, VOO slightly outshines VTI. So far in 2024, VOO has returned 17.43%, while VTI is close behind with 16.88%. Over the past 5 years, VOO has averaged 15.87%, compared to VTI's 13.4%, though the gap narrows with a 10-year return of 12.94% for VOO and 12.31% for VTI. When it comes to holdings, both share heavyweights like Apple, Microsoft, Nvidia, and Amazon, but VOO has a greater concentration in these large-cap stocks, making it more tech-heavy, while VTI offers more diversification with exposure to smaller companies and other industries. In terms of risk, VTI can be more volatile due to its inclusion of smaller, high-growth stocks, while VOO tends to provide more stability with its focus on established companies in the S&P 500. If you're looking for maximum diversification across the U.S. market, VTI might be the better choice. However, if you prefer more stability and exposure to the top large-cap companies driving the U.S. economy, VOO could be the way to go. In conclusion, both VTI and VOO are powerful tools for long-term wealth building. Whether you want broad market exposure with VTI or the proven stability of the S&P 500 with VOO, the choice depends on your investment goals, but either way, you're setting yourself up for success. If you found this breakdown helpful, don't forget to subscribe for more investing insights. Hit that bell so you never miss out on ways to grow your portfolio.